Welcome back to the Deep Dive. This is the show where we do the homework for you, filtering through the noise to find what really matters. Today, we're doing something for the very first time. We're taking a deep dive into one of Asia's biggest private healthcare players, IHH Healthcare Berhad.
That's right. And it's a fascinating company, a multi-market, complex business. We've got a great set of sources today. Analyst reports from RHB, Public Invest, TA Securities. And our mission really is to look at their latest Q3 2025 financial update, figure out the strategic shifts they're making, and, understand why analysts seem to be so confident.
And before we jump into any of that, I have to give a huge thank you to one of our listeners, Marcella. Marcella dropped a comment on YouTube asking us to cover IHH. Honestly, it was long overdue, so thank you for putting it on our radar. It's a great reminder for everyone listening. If there's a stock you want us to break down, just let us know in the comments.
Absolutely. And while you're down there, just take a second to hit that like button and subscribe to the channel. It really helps, and it means you won't miss these deep dives.
Okay, let's get into it. IHH Healthcare. For anyone who might not be familiar, can you just give us the quick primer? How big is this company?
Oh, they're a behemoth. I mean, they're not just running hospitals. Think of them as a massive, vertically integrated healthcare provider. We're talking over 80 hospitals, medical centers, clinics, diagnostic labs. And the key is their geographic spread anchored in places like Singapore and Malaysia, but with huge growth engines in Turkey, India, and China.
That geographic spread sounds like a key part of the story. So let's look at the numbers for the third quarter of FY25 because, well, they seem a bit contradictory at first glance. The top line, the revenue, it looks fantastic. It soared to RM 6.6 billion.
Yeah, that's up 16.4% year on year. That's really strong.
So management is saying this is from strong demand and a higher intensity case mix. Great headline number.
It is, and the operational side looks just as good, at least on the surface. Their EBITDA, that's earnings before interest, taxes, depreciation, and amortization, that jumped 10% to RM 1.5 billion. And that pushed their EBITDA margin up to a very, very healthy 27%.
A 27% margin is serious. That shows really good cost control.
But, Kayan, I see a little note here. You're talking about EBITDA excluding the MFRS 129 effect. That sounds like one of those technical details that can hide what's really going on. For everyone listening, what is MFRS 129 and why are we excluding it?
That's a crucial question. So MFRS 129 is an accounting standard, and it deals with hyperinflationary economies. IHH has massive operations in Turkey, and Turkey's economy has been, struggling with hyperinflation. So this rule forces them to restate their Turkish results, which creates a lot of, let's call it, accounting noise.
So taking it out gives us a clearer picture of the actual cash flow and the real operational performance.
Exactly, and that's where the puzzle starts, because if we look past that noise, the picture gets complicated.
Right, because I've got this amazing revenue growth, great margin expansion, but then you look at the actual core profit, the PPMI, and it declined 13% year on year. It dropped to RM 462 million. So how does that happen? How can revenue shoot up 16% while your core profit actually shrinks by 13%? It points to a big problem somewhere. It does. And there's another clue. The bed occupancy rate, or BOR, it actually eased a bit. It went down to 68% from 73% the year before. So when you put that together, lower occupancy and shrinking profit despite higher revenue, you have to look at the different regions. The answer is definitely in the geographic breakdown.
Okay, let's unpack that. Where was the growth coming from? Which markets were pulling that 16% revenue number up?
The heavy lifting was definitely happening outside of their, let's say, traditional anchor markets. So Malaysia, India, and Turkey all showed much stronger contributions. And that was driven by more people actually being admitted to the hospital, higher inpatient numbers. India, in particular, is on what the analysts are calling a margin convergence trajectory.
Okay, another piece of jargon there. Margin convergence. What does that mean in simple terms?
It just means that the profitability in India is catching up to the profitability in their more mature markets, like Singapore. Historically, margins in India were lower, but IHH is getting so efficient there that the gap is closing. They're converging.
Ah, okay, that makes sense. And that explains the moves they made earlier this year, right? Boosting their stake in Agilis Diagnostics and buying that Shriman super specialty hospital.
Precisely. They're buying into high-growth, high-efficiency assets in India.
Okay, so that's the good news. What about the flip side? Where was the drag?
The challenging spot was Singapore, which is usually their rock, their gold standard for high margins. But Singapore's EBITDA actually declined by 6% year on year in the third quarter, just hammered by cost pressures.
And it wasn't just costs, was it? The volume numbers look pretty stark. A 10% year-on-year decline in inpatient admissions in Singapore. Wow. I mean, for a market like Singapore, that seems like a really big drop. Does that worry you?
It would worry me a lot more if management wasn't already moving to counteract it with a really, really smart strategic shift. See, that decline is tied to two things. One, rising costs for everything, staff, energy, you name it. And two, what they call payer pressures.
Payer pressures. So insurance companies, both public and private, pushing back on costs.
Exactly. They don't want to pay for long, expensive hospital stays anymore if they can avoid it.
So how do you fight that when the people paying the bills don't want to pay for your main product?
You don't fight it. You change your product. And this is the big pivot we've been talking about. They are shifting aggressively toward ambulatory care centers, or ACCs, focusing on daycare procedures.
Okay, so let's get into the mechanics of that. The daycare ACC model. Why is that so much better or more efficient than a traditional hospital bed?
It all comes down to turnover and cost. An ACC is just cheaper to run, it costs less to build, and you get much higher bed turnover. A bed that's used for a simple day procedure might be used by 3 different patients in the time it takes for one complex inpatient to be admitted and discharged.
And that frees up the expensive high-acuity hospital beds for only the most complex surgeries, the ones that bring in the highest margins. So that slight drop in the overall bed occupancy rate to 68%, it's not a weakness. It's actually part of the plan.
Exactly. It's a feature, not a bug. It means they're using their most valuable assets, those inpatient beds, more effectively. And it's already working. In Malaysia, their 9-month daycare revenue was up 13%, hitting about 400 million ringgit.
So what about in Singapore? How are they applying this strategy there with such a premium market? Aren't they risking the brand by chasing efficiency?
That's a great question. And no, they're being very clever about it. They're using what you could call a fork segmentation strategy. They're positioning their top hospitals, Mount Elizabeth Orchard and Novena, strictly for the ultra-high-end premium patient, the luxury experience.
Right.
But then their other facilities, like Glen Eagles and Parkway East, are pivoting. They're creating standardized, packaged offerings designed specifically to meet the tougher requirements of the mass-market insurance companies. It's a two-pronged attack.
Very smart. Okay, let's shift to the long-term outlook. They've been talking about adding 4,000 beds for a while, but now they're saying the 2028 timeline is more fluid.
Yeah, and that fluidity isn't a bad thing. It's actually a sign that they're committed to being smart with their money. They're only going to expand where occupancy is already super high, which mainly means Malaysia and India.
And that leads to this huge adjustment in their spending plans. Management is talking about revising their capital expenditure, their Capex, down from MYR 3 billion to maybe closer to MYR 2 billion, saving 1 billion ringgit. What does that tell us?
It tells us 2 very important things. First, it's proof that this ACC model is just fundamentally cheaper to build out. They can get the growth they need for less money. And second, and this is the big one for investors, saving that 1 billion in spending should translate directly into much, much stronger free cash flow in the next few years.
Right. That's money they don't have to borrow, money they can use for other things.
Precisely. Now, their finance costs did go up a little bit because of borrowings for past acquisitions, but the analysts aren't worried. They see net debt to equity staying at a very manageable 0.3 times.
So the debt is under control. What about the risks? What are the main headwinds analysts are watching for?
The usual suspects for a global company, really. First, a weaker global economy could mean fewer people choosing to have elective procedures. Second, cost inflation is still a real threat, especially if they can't pass those costs on. And third, with their big presence in Turkey, foreign exchange volatility is always a risk that could lead to, translation losses on paper.
But despite all that, the analysts seem incredibly bullish. We're seeing BUY ratings pretty much across the board. What kind of price targets are they putting out?
The targets are pretty confident. They range from around RM 8.79 up to RM 9.67. It shows that the consensus on the street is that the long-term story, the growth in India and Malaysia, this brilliant pivot to ACCs, is going to more than make up for the short-term pressures they're seeing in Singapore.
That structural advantage is why we've assigned IHH a really high financial Moat scorecard rating of 8 out of 10. How do you justify a score that high, especially with one of their key markets showing a dip?
It's justified by the diversification and that incredible operational efficiency. The fact that they operate in Singapore, Malaysia, India, and Turkey is a huge shield. When one market is soft, another is strong. And you can't argue with a 27% EBITDA margin. That is a well-oiled machine. But most importantly, this shift to the capital-light, high-turnover daycare model is making their moat even wider for the long term.
They're building efficiency right into their physical footprint.
Exactly. which is a huge advantage over competitors who are still stuck with old, expensive hospital models.
Okay, let's round this out with their ESG profile. Are they checking the boxes on the environmental, social, and governance front?
Generally, yes. Our sources give them a good rating, 3 out of 4. On the E for environmental, they've got strong targets, aiming for net zero carbon by 2050.
And on the S, the social part. For a healthcare company, that's critical.
Very robust. They're focused on things like expanding health screenings and providing affordable care for the middle income segment in Asia, so they're tying their growth to a real social need.
And governance.
Looks very sound. They get high marks for being transparent with investors. The only minor point is that female representation on their board is at 27%, just a little shy of the 30% target in Malaysia. But overall, it's a strong profile.
So to wrap up our deep dive on IHH, Q3 2025 showed really strong revenue and margin growth, and that was driven by their expansion outside of Singapore. That strength has helped them absorb the short-term cost pressures in that Singapore market. And the key takeaway for me is the really successful strategic pivot to the more efficient daycare model.
For sure. Which leaves us with a really interesting final thought for you, the listener, to mull over. Given that they're cutting their planned capital spending from MYR 3 billion down to MYR 2 billion because this daycare model is so much cheaper, how much faster will that translate into immediate substantial free cash flow in 2026? And will the market start to reward them more for that capital efficiency than just for the raw number of beds they're adding?
That's a great question. It gets right to the heart of what kind of company IH is becoming. It's a huge transformation to watch.
It really is.
Well, thank you again to our listener Marcella for suggesting this topic. It was a really fascinating story of strategic adaptation.
And a big thank you to all of you for tuning in.
Please remember to like this video, comment below with your own thoughts on IHH's pivot, or maybe drop a stock that you want us to cover next. And of course, subscribe to The Deep Dive. We'll see you next time.